October was a terrible month in the stock market, with every major index being down. With worries about lingering high interest rates and conflicts worldwide, the stock market has reacted strongly, showing its lack of faith in the future of companies. However, as a long-term investor, I am not worried about the short-term fluctuations that happen, and the way I invest into my InvestEngine portfolio doesn't change, and there is no stock picking or trying to time the market. So in this video, I'm going to be showing you my beginner-friendly InvestEngine portfolio, where I deposit £100 per month regardless of what the news is and regardless of where the market seems to be heading. If you would like to sign up to InvestEngine, use the link in my description box down below. You can receive up to £50 when you sign in and make your first deposit. So as you can see, my current balance is 1,928, and as I've talked about, October was very bad. However, the beginning of November has brought on a different shift. The Bank of England did not raise interest rates again, and that has led to a recovery in the FTSE 250 and other British companies. So this time last week, my portfolio was actually down, but since that news has come out, it has gone up a bit. So this gives me an overall return in my portfolio for £63, which I am quite happy with given the current scenario. And I do think right now there isn't a lot of optimism in the stock market, and eventually there may be as the world starts to get back on its feet. So as a long-term investor, I personally do like investing in times like this. So one thing that I have noticed about InvestEngine is that they are now starting to offer money market funds. Now, I've made a couple of videos on money market funds, and I do think money market funds are a great place of storing short-term saving goals, such as your emergency fund. Essentially, what money market funds are a collection of short-term securities that are very high in quality, for example, government bonds and bonds from companies with very high credit ratings. InvestEngine does provide currently 2 ETFs that kind of try to track these money market funds. So currently those two are from the X trackers, so that's the Great British Pound Overnight Rate Swap. Currently that is giving you a yield of 4.08%, and there is a total expense ratio of 0.15%. Here is another one by Elixir, and if you really want to find out more information, you could do, but this isn't really the scope of the video. But anyway, going back into our portfolio, we can see that I have a number of different cards, and some of these cards are going to have repeated ETFs, which doesn't make sense to you, but the beauty of InvestEngine is that you can customize it exactly how you want it to. So as you can see, I have nothing in cash. I personally believe that I shouldn't really have any cash left over in my investing accounts. If I do want to keep cash, I can keep that into something like a money market fund, which now InvestEngine actually provides, or I can even put it into an easy access savings account. So the first card is the VJPN, and if I go into it, you can see that it is a mixture of the S&P 500 by Vanguard and also the FTSE Japan also by Vanguard. And as you can see, the initial weighting was 80% Vanguard USA and the second one was Vanguard JPN. However, you can override this at any point, and as you can see, the current ratio is more 50-50 Vanguard USA and the VJPN. So I haven't actually deposited into this particular portfolio in a while. That is because I made a few decision changes that I no longer wanted to invest into the VUSA and the VJPN. However, instead of selling it, I thought I'd leave it and let it do what it does in the meantime. So going back and seeing how it performed is actually pretty good. You can see the last time I invested was around January of this year, and I bought quite a few back in August when I was investing regularly into this. My decisions were actually to skip the Vanguard USA in favor of the iShares S&P 500 because that is a hedged ETF, and personally I thought I could be making a bit more return, because at that time the exchange rate differences between the pound and the dollar meant that kind of the VUSA was actually being quite steady, and I wanted a bit more volatility. That's not to say the Vanguard USA isn't a bad option. I think long term it doesn't really make a difference, but in either case this portfolio has netted me a 14% increase, so actually a very high increase, due to the fact that the majority of the investments actually were made back last year, and since then we have seen a rally, and then of course since then again we've seen a decrease. But as you can see from my net contributions, this is what I've put in, and since then it has still gone up. Investing regularly has historically proved to be a great way of actually generating wealth. In addition to just the capital gains, you do also get dividends, and as you can see, I've received £3.26 dividends so far, December 2022 being a good month, and also January 2022. And in the breakdown you can see that was 95p here out of the £1.25 paid in June 2023 from the VJPN, and then 30p from the the VUSA. If we go into the funds, we can actually find out a lot more. For example, a breakdown into their holdings, the regions and sectors, if we really wanted to know that. We can also find at a glance the dividend yield. So currently it is 1.31%. And of course, the dividend yield is a ratio of the total stock price, so that will fluctuate from time to time. We can also see the total expense ratio, so that's 0.07%, which is actually really good, lower than the iShares. So like I said, long term there might not actually be any differences, however in the short term there may be. You can also see all the price points you bought it, and as you can see, I haven't been investing regularly, and of course if I did, in retrospect, remember past performance is not a guarantee for future performance, but in retrospect, if I had kept on investing, I would be making significant capital gains. So that's the first portfolio, and I have a few more to go through. And again, the second one is a mixture of the Vanguard USA again and the Vanguard Germany All Cap. The reason why I made different portfolios is because I kind of want to separate my investments mentally, but again, you have all the power and all the choice to make your portfolios, your different cards, exactly the way that you want them to. So again, as you can see, the ratio is pretty much currently 55-45. Initially, I set it up as 95-5, but you can change it however you want. The thing I like about these cards is that if I did want to invest into the Vanguard USA, I could just go into here, and then I could just literally just go into here and buy however much I want to. I don't really have to make another card for that. I can do it like this. Honestly, it doesn't really matter. As long as mentally you know what you're doing, then it's fine. No one else really needs to know what you are doing. But as you can see, I also decided at that point in time to invest in the Vanguard Germany All Cap. And again, I like having the card, so it lets me know what period of time I was doing what. Since then, I haven't actually kept on investing, and then in retrospect, actually, that could have been a good idea. As you can see, it has just gone down since. But again, past performance not an indicator for future performance, and if anything, this potentially could have been a good point to dollar cost average into it. But again, not investment advice. I'm not telling you to do anything. But anyway, this portfolio has generated me 9.95% return, which is actually really good, all things considered, and that is a return of £9.62 in a portfolio worth only around £87, which is super good. And again, that's testament to having invested a lot earlier, and as you can see, throughout the years, investing regularly, chances are, given all the data that we have so far, there's no guarantees, that if you invest regularly over a long period of time, you're going to be making your gains later rather than sooner, and it really is a game of patience and a game of not listening to the news and investing as you go along. So the next portfolio I have is named the GSPX, and if we go into it, we can see I only have one holding, so 100% of the iShares S&P 500. And like I explained to you before, I decided to just move on to investing in the S&P 500 through exposure of the iShares GSPX. My reasoning were that it was hedged, so the currency differences between the American dollar and the British pound didn't make a huge flatlining effect that we saw with the Vanguard USA. The total expense ratio is 30% more, so like I said, in the long term you are very unlikely to see huge differences between the two funds because the hedging does cost more. The value that you might gain from that, you might be taken out of the total expense ratio in the long term. But that being said, the current dividend yield is 1.21%. And here you can see all the different prices that I did buy it at. And as you can see, I had been, until this bit here, buying regularly into the GSPX. And you'll see in the next portfolio what I have been buying during this period of time. But as you can see, I did come back to the GSPX and continue to buy in there. That's the beauty of having different portfolios. You really don't have to keep contributing to one. You don't have to go all into one. You can just change whenever you want to. And that's exactly what I did. You can see that I bought at £6.57 compared to the price now. That seems like a bargain. Again, in retrospect, everything seems crystal clear, but past performance, I can't say enough, is not an indicator for future performance. Your capital is always at risk. Here it is with my net contributions, and as you can see, this portfolio right here has netted me 11.44%. You can see that my first deposit into this portfolio was last December, so it hasn't even been a year and I've made 11% on my money, which is a whole lot more than if you had put money into a bank or even a money market fund. So it just goes to show that investing for the long term, historically speaking, has always beat stuff like cash and bonds. So that is a return of £54.49, and I'm actually very happy with that, and I'm very glad that I kept consistent, even though it's a small amount of money, even though I would say this is more a beginners friendly and a more representative to most people. £100 a month could be a lot to a lot of people, especially given the cost of living crisis. I do think that it is a very reasonable amount to save and invest. As you can see, 11% of my money is not too bad at all, and I think that has been inflation beating or at worst worst inflation leveling. So the next portfolio I opened was again for a very short time, and that is labeled the DAX. I've only actually made one contribution here, but this is into the Vanguard Germany All Cap. And again, like I said, I have got this ETF in another fund, which was the VUA VJER. But again, if you wanted to, you can make your own portfolio, just because it really does make it easier to track your money. Maybe you got a gift from somewhere and you just want to track how some person's gift did as opposed to your own money. You can really do that. Or if you wanted to separate your birthday presents or whatever you want to do, it makes it very easy and very useful to have different portfolios. For example, if someone gave me a gift of £45 and I wanted to see how that performed over time, I could do that. Unfortunately for me, this portfolio hasn't been doing too well, and we can see this was in the Vanguard Germany All Cap, and that has a negative return of 6.32%. So that is a £3.11 loss. It also goes to show that just by depositing one point in time, you're not making the most out of long-term investing. And if I had kept investing, perhaps buying here maybe and then buying there again, I would be leveling out my average buying price, and over the long term, hopefully that will lead to a good increase like we've seen with the other portfolios. And lastly, I have my most fun portfolio, which is labeled the FTSE 250. And again, we can see that it consists of one fund, 100% of the Vanguard Mid, which is also called the Vanguard FTSE 250. We can even go into the company and find out what the holdings are. For example, we know that it is 84% UK and then a bit of the rest of the world. Sectors that it focuses on is financial mostly, but also some of these sectors may overlap. So it's worth, if you really want to find out, to actually go into them and find out for yourself. It's a very diversified in terms of company numbers, but very heavily UK focused fund. It is also super volatile, as you can see. I've bought many times throughout the year. You can also see that in the end of October it reached a point of £25.95 and has since jumped up back to £27.80. In terms of dividends, so far I've received £4.72, and it does have a very high dividend yield of 3.56% with a total expense ratio of 0.1%. So in this portfolio you can see that I have a negative return of 1.17%, which is actually not too bad, and that is a loss of £20.42. You can also see my net contributions of £655, and I'm actually going to continue investing in either the FTSE 250 and the GSPX, as those are my two preferred ETFs. And then maybe in the future I'm going to be looking at diversifying to get more exposure in developing countries. But I think for now, the FTSE 250 and the S&P 500 are where my money will be going into, as I am okay with the level of risk, which is pretty high. And there's no guarantee that such an economy such as the S&P 500 is going to continue giving the amount of returns it has in the past, compared to developing countries, which have the potential to be making a lot more growth in a shorter amount of time. Granted that they also could be a lot volatile and unpredictable. I currently don't have an ISA with InvestEngine. However, I am kind of thinking about opening an ISA or transferring my ISA from free trade into InvestEngine. The thing I like most about InvestEngine is that it's a no-brainer way of not timing the market and not caring about what people think. All of these portfolios that I've mentioned, for example the GSPX, have a feature called Auto Invest right in there. Whenever the cash goes up to £1, for example from dividends, as you can see in the GSPX, I didn't mention, but I received £10 in dividends, which was really high. In September I received £5.42 in dividends, which was actually really good. Auto Invest is the feature that actually reinvests the dividends, so you don't even have to worry about that. I really like this feature, and I think that it's very big and friendly focused, and it's a great way of actually it becoming carefree and not thinking about it. If you want to make it more automatic, which I don't mind being a bit manual, you can actually set up savings plans, and I would actually recommend this. What savings plans does is that you can set up weekly, bi-weekly or monthly deposits from your bank account straight into your portfolios. For example, for me, if I wanted to do £100 a month, that will come out as a direct debit from my current account in here, and everything will just get reinvested automatically. I think it's great. I personally don't do this because I don't really have too much money in my current account. I keep everything in separate accounts and then I do everything manually. But for 99% of people, I think such a thing such as a savings plan could be a great option. So I'm definitely thinking about either depositing more into InvestEngine or making it my ISA, as I am really happy with the returns I've gotten because I haven't been trying to time the market. I also wanted to show you my analytics. So let's go into analytics. We can see my total balance, 1,928, slowly becoming larger and larger as I deposit £100 a month. You can see that I've invested 100% into equities, so no bonds or anything like that, just stocks and shares. 54% of my exposure is in North America, 28% in the UK, so very Western focused portfolio. 5% is in Europe, again more west, 5% is in Japan, only 0.1% is in emerging markets, and 5.3% is the rest of the world. I can also find out about what sectors I have exposure to. For example, I have around 22% in industrial, 16% in technology, 15% in financials. Just by looking at this and ignoring region, because I think I'm very heavily Western focused. But if this was a global fund and I had this allocation to the sectors, I think I'll be quite diversified. As I'm not too technology heavy focused, I have exposure in industry, financials, consumer, healthcare, and the rest such as property, energy, mining, and other. You can also see that I have exposure to 1,402 companies, which is actually really high. Microsoft and Apple being the highest by how much I've invested into. And finally, you can see again 100% equities, 100% stocks, nothing like bonds, and a very small amount of cash, 69p in my GSPX account, just because £1 would be the minimum required to actually reinvest that money. If you would like to sign up, make sure to use the link in the description down below, and make sure to check out some of my other videos, and I will see you in the next video.